But let's welcome on board Puneet Chhatwal, MD and CEO at Indian Hotels, joining in on the show right now. Puneet, hi, morning. When we last spoke with you, you said that April to May 2019 has been sluggish. Tell us how the Q1 numbers have been in terms of the two events, the slowdown, the jet issue, the ongoing elections, all of it coming in the quarter.
I think that's absolutely right. When I was last with you, I mentioned that since 15th of March, there has been a general slowdown in the top line development. So that part is there. And I also, however, mentioned it is the job of the management to continue to work despite these headwinds and keep using market share as one of the key fundamentals. We can't change the macroeconomic factors, we can't change too much the top line, but definitely we can increase our market share, which we've been able to do successfully, optimize our cost level, which we have also done, continue to grow the company. We've grown by further 7 contracts in the last quarter, which is more than the same quarter last year. We opened 3 hotels, and as you asked in the previous question, I think we have also been assisted by strong performance both in US and UK, where we have assets in New York, San Francisco, and especially London has been very, very strong for us.
Okay, so could FY20 be the year of pricing-led growth pickup and the best ever commissioning run rate for the company?
I think we'll continue on our promise on the delivery of the margin expansion that we have openly communicated to the market. However, the visibility is poor. We are at the moment experiencing a lot of volatility, both globally as well as on the national front. So making any statements about what will happen in 6 months or 1 year may not be very opportune or appropriate at this point of talking. All I can say is that the rate growth that was expected is not coming in the way and form that we would have all liked it to come. However, and having said that, we definitely see that we'll continue to improve our performance as we have communicated in line with our strategy of Aspiration 2022.
Now, hotel industry in India has been witnessing growth in occupancy rates, but if you look at hotel room prices in dollars in terms of hotels, have not gone up well at all. In the last few years, do you expect hotel prices in dollar terms to go up?
See, normally they should, and I think when we had very high rates almost 10-15 years ago, then it was a combination of 2 things. I think the supply was very subdued and the demand was very strong. Today there is a proper balance in both the demand and supply situation. But secondly, there was no GST, and anything above 100 euros is taxed at 28%. That also kind of curbs the rate growth that we would have normally witnessed even in such times. So I think if we are getting into higher single-digit growth on the rates, then it would be quite good. We had last year approximately 10% growth, which was very, very good. I think if we get anywhere close to that number this year, we would be more than pleased.
When do you see pickup in pricing and occupancy rates, and how will this lead to margin expansion?
Well, if both are doing well, then it's great for margin expansion. I think the only then what you have to do is your ability to convert that top line growth, especially the one coming through rate, should really flow down to the bottom line directly. So I think that would be a fantastic scenario. At the moment, the occupancies are still holding up. They're quite strong. We're just, I think as an industry, we are waiting for the rate growth to come in the way we would all like to see it at a double-digit number. But in the current circumstances, it's a very difficult call to make. I think we'll have to wait for 1 or 2 more quarters to see that happening.
Sure. Puneet, in your, in the kind of sense that you're getting from consumers, do you feel perhaps there is a pickup in late July, August, as opposed to what we saw in April, May?
Definitely, that's a fair comment to make. April and May was quite difficult June came in much better than expected. So has July been, especially for us, as I said. We have some hotels abroad, and the market, especially in the Western Hemisphere, in London, did exceedingly well in July. So we are very positive on that. Also, as we have a lot of resorts in our portfolio, we are the market leader in the resort segment. I think that is very much, covered up for any kind of negative scenarios, because people do go on leisure travel no matter where the market is headed, and everyone likes to take a little break or a staycation. And I think from that point of view, we did see a more positive June and July than in April and May. But I would again like to come back. We have to be very cautious. We have to continue to drive our performance operationally, but also in terms of continuously gaining market share. And we are very confident with the growth in our portfolio, with more and more hotels coming online on management contract basis, like a hotel a month, that too on different levels of branding, from a Ginger to Taj. I think we will be able to deliver on our promise of 8% margin expansion.
Great. Let's also talk about the overseas performance. That's been a challenge, for the company in the past, particularly for the past 3 years or so. You've also now been able to reduce those losses in that time. So going ahead now, what's the performance looking like in Q1? What's the outlook going forward?
As I said before, I think overseas we only have a leasehold interest in one asset, and we own two. And the two assets that we own have been very, very positive. The one which we have as leasehold, we have been able to, drive much better performance there. There will always be a challenge. In the last quarter when we spoke, or the last time when we spoke, I did mention about the challenges in Sri Lanka. Last year, similar time, there were challenges in Maldives. So there will always be one or the other geography where things are not working the way they should. But we are very much pleased with the performance of our international portfolio, and that is pretty evident in our consolidated results. These consolidated results for the last 5 quarters have been superior than anybody else would have expected, and this is mainly driven by our overseas performance.
Right. Leverage, Puneet, has come down significantly for you. Do you expect most of the growth now in the company will happen at an asset-light level, which will keep the debt level in check?
Absolutely. We are not going to go on an asset-heavy model. We have signed almost 30 contracts in the last 14 months, and 29 of those 30 are based on not us investing ourselves into a property or taking on debts. We recently also announced a platform with GIC, which will help us to monetize our own assets as well as to acquire those coming as distressed assets on the market. So definitely it's a very strategic move from our side to balance our portfolio, come to 50% business based on management contracts and 50% on owned. And let's not forget, we were more than 70% owned portfolio, which we have been operating. So I think we are getting very close to that balanced portfolio within the next 8.
Okay. Wanted to understand the operating performance of your company as well, which has been improving, led by growth in the F&B revenues. Do you see that continuing to grow in double digits?
I hope it does, because if there is one place on the planet where this happens quite well, is definitely in Middle East and in Asia. And within Asia, because of our concepts of weddings being one of the most important festive occasion in any family, and and we especially with our Taj brand, tend to benefit very strongly from the wedding market. So we do expect growth in this segment, and also we will be introducing soon a few more brands to liven up further our food and beverage, a market leader position that we have had for several decades in this segment, and we have no intention to let that get diluted, whether through macroeconomic circumstances or competition coming into that space.
Can you walk us about your partnership with GIC, how the synergy is panning out, and what are you looking at an investment to the tune of about 4,000 crore? Can you share details on how would you plan to deploy it?
At the moment, we are just building a pipeline of possible projects, and I think in due course we would be ready to announce our first project. As and when we get to that point, I think I'll be able to talk more about it.
In order to drive revenue growth and profitability, Puneet, does the company remain on track really for its strategy, Aspiration 2022? You've been heading clearly towards that. Just share with us, where you are in that journey.
So far, we are not only on track, but we are a bit ahead of what we have communicated. So we finished last year at almost 20% EBITDA margin. We have started off well in Q1 of this year. So, when we announced the strategy, we were at 17% margin. We have grown quite well. We have added a lot of hotels to our pipeline, much more than we had communicated. At the same time, we have added a platform for acquisitions together with GIC. We have been able to monetize some non-core assets. I think that process is going to, go further. We've been able to get out of some tertiary markets through our associate and JV companies for hotels in Visakhapatnam or in Trivandrum, bringing down debt in also those associate companies. We've been able to drive much better ratio between debt to EBITDA, which is down to 2.11. And expected to go down further as the EBITDA continues to rise. So I think we are very focused on, the very simple promise that we said is we promise and we deliver. And so far, the 5 last quarters since the announcement of this strategy have absolutely been either in line or have exceeded the expectations.
Puneet, thank you so much for joining us on the earnings this time around. Thanks so much for being with us on ET Now.